Welcome back to CryptoPhilly, where we break down crypto chaos into clarity. I'm your host, Sean from CoinFlask, and today we're diving into one of the most confusing yet common crypto tax traps we've ever encountered: airdrops and forks. They sound like gifts from the blockchain gods until tax season hits. So, if you ever woken up to free tokens in your wallet and wondered, wait, do I owe taxes on this? This episode is for you. So let's get into it. First, let's define the two stars of today's show. A crypto airdrop is when you receive free tokens, often as part of a marketing campaign or loyalty reward. Maybe you held a token at a certain snapshot or joined a whitelist, and boom, tokens appear in your wallet. Sounds great, right? Then we have the hard fork. A hard fork, on the other hand, is when a blockchain splits into two. This can result in holders of the original coin receiving an equal amount of a new coin. A classic example is the Bitcoin versus Bitcoin Cash split. In both cases, you didn't buy anything, but the IRS still sees these as income. Here's where it gets tricky though. The IRS says airdropped or forked tokens are taxable when they have dominion and control, meaning you can sell, trade, or use them. Not just when the project announces them, but when you can actually access them. So let's break it down. Here's the airdrop example. So say you receive 500 new tokens on January 1st, and they're worth $2 each on that date. That's $1,000 in ordinary income, reportable on your tax return. Here's your fork example. If you held Ethereum and the network forked, giving you ETH F coins, F standing for fork because this is a hypothetical example. So if you held Ethereum and the network forked, giving you ETH F coins on September 1st, and you could access and trade them immediately at $100 per coin, that's $100 of income per token received. And yes, that's ordinary income for both of these, just like your job, freelance work, or even interest payments. Now here's that double whammy. When you eventually sell or trade those airdropped or forked tokens, you also pay capital gains tax based on how much the value changed since you first got them. So let's go back to our airdrop example. You got 500 tokens worth $2 each. That's $1,000 of income. 6 months later, you sell them at $5 each. Now your total proceeds are $2,500. Subtract your original $1,000 cost basis, and you got a $1,500 capital gain. Depending on how long you hold them, or you held on to them, let's say less than a year, that means your short-term capital gains, taxed like any ordinary income. Now, if you held on to them for more than 1 year, that's considered long-term capital gains, which means lower tax rates. So yes, your quote-unquote free tokens might come with two separate taxes. Now, this is one common question that I usually get. If I didn't claim the airdrop or didn't know about the fork, do I still owe taxes? In most, well, in most cases, no. Not until you have access to the coins. If they're just sitting out there unclaimed or you didn't have the right wallet at the time, it's like unredeemed credit. However, once you gain control, that's when the clock starts ticking, both for income and potential capital gains later. So be mindful of whether your wallet is eligible for automatic deposits or manual claims. Now, let's talk strategy. We're going to divide this up into 3 different things. First, keep good records. I've emphasized this multiple times in the previous episodes as well. But when it comes to a good strategy, it starts with keeping good records. Make sure to track the date and the value of each airdrop or fork when you gain control. Use crypto tracking software, which can help automate some of this and make it easier for you when tax time comes around. And I'll list some of the recommended software in the links below. Second, consider the tax impact before claiming. Sometimes it's better to wait if you know the token will dump in value, especially if it saves you from reporting taxable income at inflated prices. There's usually some coin that comes out that might be worth $1 when it's airdropped, and then within a week crashes down half or maybe flat out zero. So timing is everything. So make sure you are doing your research and claiming the token when you think it's the right time. Lastly, number 3, don't forget Form 8949 and Schedule 1. You'll need to report the income from airdrops and forks and any future sales using these IRS forms. So, when all is said and done, consult a crypto-savvy tax advisor. This stuff can get messy, especially when you're transacting across multiple wallets, chains, and even potentially jurisdictions. So to wrap things up, remember, crypto airdrops and forks can feel like free money until that tax man comes calling. The key takeaway though, free doesn't mean tax-free. If you're serious about crypto and want to keep the IRS off your back, you've got to take and treat every token, even the freebies, like potential taxable events. So that's it for today's episode of CryptoPhilly. And if this helped you, drop us a follow, leave a review, and share it with your crypto crew. Until next time, keep stacking, keep tracking, and keep it legal.